Noon, Eicher Motors, the one that Prakash just spoke about, has moved higher. Coal India as well has recovered a little bit, but I think L&T, that's the larger weight in there. When that moves, it helps the index, and even Tata Motors, both of them relatively larger in comparison to the other names, and that's why we're up a good 80, 85 points on. Let's talk about a couple of numbers. Federal Bank, that's reacting to its Q1 numbers. Bank has reported the best return ratios in the last 25 quarters. Abhishek is standing by with a detailed fine print. Hi, Abhishek.
Hi, Nigel. So there has been an increase or partial increase in the risk as well, which has led to, return ratios being the best in last 25 quarters. So take a look, risk weight to advances ratio is at 87.2% when compared to 84.4% in the previous quarter. Despite the increase in, risk, it has been profitable given the fact that it's not spilled into asset quality woes. So return ratios are the best in 25 quarters with ROA or return on asset at 1.1%. and ROE at about 12.7%. The slippages increased on a sequential basis, coming in at 463 crores when compared to a little under 400 crore in the previous quarter. In the slippages, it was largely led by the retail portfolio, which saw a slippage of about 204 crore when compared to 86 crore in the previous quarter. Asset quality remains stable given the fact that they have had strong recoveries and upgrades. So gross NPA ratio declined by 11 basis points quarter on quarter. Other income was weak, down 30% YOY and about 2.7% sequentially. This was on expected line given the fact that all the banks will face mark-to-market treasury losses. Fee income robust on a YOY basis but declined partially on a sequential basis. Net interest margin on account of increase in risk that they took on balance sheet improved to 3.22 when compared to 3.16% in the previous quarter. And largely in line with our poll. However, PAT has beaten our poll. Back to you.
Okay, all right, Abhishek, thanks for that. Well, Abhishek, let's get done with the other number as well. HDFC Bank, that's going to be the big mover because it's going to come out with their numbers tomorrow. You're going to be a busy man, Abhishek, but tell us, what do we expect?
Well, Nigel, the business update has already come in for HDFC Bank. We need to watch out whether the net interest margin will remain stable or improve on a sequential basis. Now, slippages of formation of bad loans is expected at 3,500 crore as per CLSA. This compares to 4,000 crore in the previous quarter. One key point I like to highlight is that on operating profit front, core operating profit or those operating profit without treasury income, CLSA expects that to grow by 11% YOY and 1% sequentially. However, if you take into account the treasury income as well, Kotak Securities estimates operating profit decline of 15% YOY and about 21.3% sequentially. So asset quality largely to remain stable. We are working with an NII growth of 15% YOY and about close to 4% sequentially, while we are working with a profit growth of 21.7% YOY, while a decline of 6.4% quarter on quarter. Back to you.
Okay, thanks, Abhishek, for that. Prakash, you want to weigh in on both the names, Federal and HDFC Bank?
So, I think Federal Bank was, it's a small bank, so, it doesn't really set the tone for the entire sector. But, if HDFC Bank comes up with these kind of numbers where there is very clear improvement in metrics that are likely to be across the sector, then it's going to be very important or very critical for us to see Monday start with a little bit of a listing on bank. But in terms of the HDFC Bank earnings, more than that, I think it's a commentary on how they are gearing up for the merger, the potential merger with HDFC Limited. I think that's a big concern for the bank shareholders more than anything else at this point, because it's structurally it kind of ends up making you own a very different animal. And that's what I would look at. But I think the Federal Bank numbers also tell you that this whole thing that and you and Rima had a very lovely interaction with Madhu some time back. I remember where you were kind of presaging the improvement in provisioning and the write backs that a lot of these banks would start having. So they'll have more money coming back from recoveries than what they would have to provide for, and that's going to be a very sweet spot to be in. And that's reflected to some extent in Federal Bank. And the segments that are likely to grow also benefit a lot of NBFCs. That's a remarkable pocket that could start working up. They're doing very well on agri. They're doing very well on business banking. And that's precisely where a lot of these NBFCs are focused, and they could benefit from this upswing. So I'm quite positive on that sector. And the numbers do kind of give you that encouraging feel that they could be across the board going forward.
I mean, actually, HDFC Limited is also doing very well. Actually, on the Nifty, it's a single largest contributor to gains. 20 points, 20 index points coming in from HDFC with a 2% pop. It's followed by HUL, which is adding about 13 index points. And then there is HDFC Bank, which is adding 12 points. L&T and Mahindra also figure with 10 and 5 index points respectively. So that's basically the list. Market breadth is, we started with 1:1. It's moved up a little bit. I mean, it's separated by about 100, 150 odd stocks. The Nifty also has moved up a little bit, 83 now. So slow and steady, but it's sort of waking up after pretty much a lull through the course of the day for the major part of it. In terms of broader market names, you've got lots of these, small and mid caps coming up with large volumes. There is JK Tyre, there is Aster DM, which is up 7%. Sequent Scientific is up 8%. Latent View has been buzzing since the morning, which is up 5%. Syngene is up 4%. We had the management with us earlier, and so on and so forth. Any names here? DCM Shriram is another one which is coming up, 5% gains there. Anything you track out of this lot, Prakash?
So I think you touched upon JK Tyres, and I think that's a segment that's really very, very much in conjunction with the revival in auto OEMs. You'll probably start seeing a lot of ancillaries join that pattern. And JK Tyre particularly, given the fact that they've had a very strong export orientation towards Latin America and the US itself, is where the pockets of growth are, Prashant. And importantly, the raw material pressures that the tire companies faced about 6 months back have dramatically eased out. Whether it was chemicals, whether it is carbon black, a lot of those things have started making a favorable kind of a mix for all these tire guys. And the scale up that we are seeing, be it Apollo, be it SIAT, be it JK, I think it's going to definitely help them do much better. Of course, JK needs to deleverage as and when they get cash flows on their side. But as a setup, I think it's not performed in the last 12 months, but it could kind of catch up very well going forward. So that's one name. And of course, Syngene is a great secular trend line that's kind of very clearly emerging what it's likely to do. And this kind of a scale and visibility for 10 years in that tie-up that they've done with Zoetis is something which helps them scale up on other relationships as well, right? So that's going to be the spin-off, and that's why the market. Look at the volumes. Today you've seen people lap it up far more than what we've seen in the last 3 months, and that very clearly shows you that it's changing gears. So keep a watch. It'll surely be in the news for the good reasons going ahead.
Okay, Prakash, stay on. We have more questions for you, but before we take our first break, let's revisit the sector of the moment, which is autos. And this morning, of course,